the value of the business is the value that's created when you bring people together to create something. Doesn't matter how much revenue you have. It matters how much cash you have. If you don't have enough cash, you're going out of business. You really need to have a good idea of where you want to be 15 or 20 years from now. The vast majority of small businesses will never sell. Learn what it means to stay awake at night wondering if you're going to hit payroll or not. Because the truth is that a business is the direct reflection of its owner.
All right, I'm super excited for this week's episode of the Silicon Valley Podcast. So I was listening to one of my favorite podcasts out there, David C. Barnett, and this gentleman was on the podcast. And while I was listening, I went, I have to get him on mine. So I reached out. Luckily, he responded. I was pretty surprised that he did with his LinkedIn voice messages because he's not the typer, but he's got an incredible book coming out soon that just from that interview and my conversations, I know it's going to help a lot of people out there. So with that, I'd like to introduce Jed to the Silicon Valley Podcast. Jed, how are you doing today?
I'm great, Sean. Thanks for having me. And yeah, I'm on a personal mission to get as many people as possible using voice messages on LinkedIn Messenger. It's way better. It's so much faster than typing. And you get that personality. You get to actually hear a human being on the other side. And it's definitely better for connection too. So if you're on it, if you haven't tried it, try voice messages. I get lots of positive feedback just for doing that.
All right. So now you've basically changed every one of our listeners' social media habits. But when you're not doing that, give us a little background of your career up to this point, a little bit about your book, and then we'll just dive right into the questions.
Sure. Very quick background. 10-year Air Force veteran. Spent that time doing financial management and acquisition. Think starting off base level, doing little things, and then working my way up through special operations. Served in Europe for a little while, a couple deployments, and then ended my 10 years at just outside the Pentagon, working on the next big defense acquisition project. Think like super secret stealth planes and stuff. So that was fun, but I was ready to make a change. I didn't want to stay in financial management for the rest of my life. And to be honest with you, I had no tech background, but I was so frustrated with how convoluted all the systems were for the DoD. Like all of them were just terrible. Everything's being balanced on Excel spreadsheets, to where I started Googling how to use Python in like 2019. I was so frustrated. Anyway, so I get out and I don't really know what I'm going to do. So of course I go get my MBA at NYU Stern, but fantastic opportunity, by the way. But that experience of just being so frustrated kind of got me interested in tech. And it happened to be at that exact moment that Microsoft was hiring anyone with a top secret clearance to come and be a software engineer in their Azure cloud. And I raised my hand real fast. I was like, yes, absolutely. And their whole thing was like, look, it's so much easier for us to train people to be software engineers as opposed to, as long as they've already got the clearance. It's so hard to get the clearance. And so the whole thing was like, hey, join us. The first 6 months is like a crash course for me, it was for DevOps. I was a site reliability engineer. And so I did 6-month crash course in DevOps. And then I stayed at Microsoft helping to build out the Azure cloud for federal clients for about 2 years and just drank from the fire hose. Like it was an incredible experience, learned a ton. From there, I transitioned to briefly to AWS as a technical program manager and then on to HP as a senior technical program manager. Really loved what I was doing, had a lot of fun. I found that, I kind of found that sweet spot between being able to understand the engineering teams and understand the code without actually being a very good coder. And then be able to speak that into layman's terms to the product guys and the customer success guys. So that was great. But I had this itch from the very beginning of wanting to do something for myself, wanting to own my own experience. And in the fall of 2021, I was finishing up NYU Stern, and they had a class on entrepreneurial finance. And that was the first time I ever read anything that had to do with small business multiples. And something just clicked. I was like, oh my goodness, people buy these businesses, like small businesses, they buy them? Never occurred to me. And remember, 2021 wasn't long ago, but it was before the buy a business hype that you see everywhere on social media. There was none of this on social media at all. And so, of course, I go straight to Google. I'm like, man, I got to learn more about this. And the only resources available were the HBR guide to buying a small business and Walker Dival's Buy Then Build. That was it. That was all there was. And so, of course, I read both of those. I attended the Harvard conference. I attended the Chicago conference. I networked with as many people as I possibly could. And so the entire time I was in tech, I was kind of doing this search on the side, learning it, from the ground up. Like, what is search? How do acquisitions work? Building my network until ultimately I left HP and bought 2 landscaping companies in Southern California. And it went well for a few months, and then it went really bad. And 8 months after I acquired them, we had to declare bankruptcy. And so it was an incredible experience of understanding what it means to search for, buy a business, turn things around, and at the same time experience failure in the most epic sense. And so after that, I learned a lot. I came back on LinkedIn. Now buying a business is everywhere now. Everyone on social media is talking about it. And August of last year, I finally just logged back into LinkedIn, and I just started seeing all the hype out there, and just started doing some common sense responding. And it really resonated with people because, we hear a lot about all the successes, but almost never anything about the failures.
So let's dive a little bit deeper there, especially for the audience. I mean, most of our audience is entrepreneurs, investors from the tech world. And I've had several conversations where people go, "Oh, I'm done with tech. I'm going to go buy a roofing company, a painting company, a landscape, and something like that." Now, your background is also tech. I mean, what advice do you have for these people that saw something on YouTube or Instagram or TikTok or that and thinks, "Wow, this all I got to do is implement this one software system or something," because they're all doing it by, pen and paper.
Sure.
And I'm going to be rich in no time. And this is my path to freedom.
I would say that it is a path to freedom for some people and some businesses, but it is definitely not a path for freedom for everybody. And most people do not succeed. Regardless of, and everyone points at like, oh, the SBA default rate is like, 4%. I think right now it's like closer to 7%. That's only what's actually tracked. There's a lot of failure out there. And we're not even talking about the people who I consider to be in business purgatory, where they have a whole ton of debt. The business isn't doing well. They're just barely covering their debt payment, and they hate their lives. And they're basically living like in financial obscurity. And so what I would say is that, look, it's not about getting rich. If you want to buy a business, it's about understanding what kind of lifestyle you want to live. Like, if you want to spend the next 20 years of your life being the owner operator of a plumbing company, then that's great. You need to understand that's okay. It's a wonderful way to earn a living, especially if you want to be really involved in your community. If you want to get away from your computer and actually have hands-on and do the work, some people really like that. If you want to control your own outcomes, that's one of the big things. Like, people want to know that, like, hey, I have no ceiling. The more I work, the better I do, the higher my revenue, and I get to keep that. That's a very appealing to people who have been, in corporate their entire careers. But also, you need to consider the other side of that too. When there is no ceiling, that also means there is no floor. And we all know that your job can lay you off at any time. That's absolutely true, and you need to be prepared for that. But when your business goes under, that's very different than your job laying you off. For the biggest reason being, if you bought your business using the SBA, well, now you owe a lot of money, most likely multi-million dollars of debt, in which case you're going to have to declare personal bankruptcy. And that's not the end of the world. I know a lot of people who have gone that route, unfortunately, but it is not fun. It's not easy. And it absolutely will destroy you financially and puts a huge burden on you and your family. It's difficult to recover from. And I know exactly what that feels like. So you really need to have a good idea of where you want to be 15 or 20 years from now. And the biggest thing to think about is, look, the vast majority of small businesses will never sell, something north of 90%. You have to understand that you're not special. If you buy a company like this, and I really hope you're successful, I more than anything. But even if you are successful, you're probably not going to experience an exit. That's just the truth. And Sean, you know this well because you're in investment banking. Most businesses do not experience a liquidity event at all. And so you have to be comfortable with the fact that, like, hey, maybe this business I buy, I'm able to implement things over time, definitely not 2 or 3 years, but over maybe the next 7 or 10, and get to a point to where I become an attractive target to maybe a PE group or a strategic. That's possible. It's not likely, but it's possible. But you have to be very comfortable with your base case. And your base case is that I'm going to own this thing for 20 years. And you have to get real comfortable with that, because there's no getting out of it. It's not like your house. You can't just put it up on Zillow and sell it. So it is the riskiest and most illiquid asset in America. That being said, the vast majority of millionaires come from owning businesses. So like owning something that actually creates and generates value is really important. But that doesn't mean that you have to go buy an HVAC company to do that. It is just a route. Just like you don't have to do a startup to get rich, but it is a route. You could just as easily stay at Microsoft and do that for 30 or 40 years, taking huge advantages of like the mega backdoor Roth IRA and all your equity investments, all that stuff, and have a killer tech career, and you'll get rich that way. Like there's a lot of ways to get rich. The biggest thing is just for you is understanding, what kind of lifestyle do I want to lead? Do you want to wake up on Saturday morning and go help clean out, some plumbing? That's fine. Some people are cool with that. And some people definitely don't want to, work at Amazon for the next 30 years. So you really have to think about the lifestyle, because you can get rich in a lot of ways, but it's what you want to wake up to every day. Because when you make that decision, it's very much a one-way door in a lot of ways.
Are you open to sharing a little bit of your experience of owning a business, the ups and downs?
Yeah, absolutely. So, look, where do you want me to start? I'll start right off the bat with just, especially when you're coming from tech, digital transformation is a very attractive part of buying one of these businesses, right? Because we look at them and we say, oh, look, they're all paper-based. They're all running off checks. God, there's a fax machine in the office. Oh my goodness, they even have an office, like all this stuff. And you're like, I could digitize all this and I'm just going to wipe out the back end and put it all in the cloud and it's going to be fantastic. And that may be true theoretically, but in the real world, people don't move like that. And here's an example. When I bought my company, they were doing 95% of all invoicing was done by mail, by check. And so you can imagine, I was like, oh man, just doing digital invoices would be great, because our accounts receivable were, 60 to 90 days on average. So we're waiting a long time to get paid for these projects. I'm like, man, if we could just do digital invoices, things would really go a lot faster. And what I found is that well over half my customers were not interested in doing a digital invoice whatsoever. And these are professional, management companies. They've been writing checks for years, for decades, and they were not interested in doing a digital online payment, just not at all. Right off the bat, there were maybe 5 or 6 of my customers who were cool with it. The rest of them, like literally, I'm on the phone and they're like, "Is this a scam? Is this real?" Like I'm showing them on the webpage and like, yeah, it's just an invoice. It's a digital invoice, a Stripe invoice, and they're like, doesn't look trustworthy to me. I'm like, and I'm thinking, you go on Amazon and buy stuff every day, but my invoice doesn't look trustworthy to you? Like, you don't understand, like, people are so stuck in their ways that there's a reason why change management is an entire discipline in business, because people don't want to change. People are very entrenched in their place. And if you're not in a position to really push your change and be okay with the idea that maybe the people you have on your team are not the right people to make this change and you need to let people go, then you're going to have a hard time. And that's a really hard place for brand new business buyers to be in, especially if you're coming from tech and you're now like, let's assume you buy a plumbing company and now you're surrounded by, a team of like 23, plumbers. 3 or 4 of them are master plumbers who lead teams. The rest of them are just blue collar workers who all they do is plumbing. Half of the people on my team didn't have an email address. Most of them did not have bank accounts. And as a result, like having a tech conversation with people like that is very, very difficult. And you're a one-man IT shop. And you're surrounded by people on your team who don't want to make that change, customers who don't want to make that change. And that's why I say, like, you can do this. It takes time. It takes a long time to turn that kind of ship. And sometimes it involves getting new people on board. And that's very difficult, because if you buy that plumbing company and you've never been a plumber, well, then you might feel some sort of way about letting one of your master plumbers go. That's a scary place to be, because what are you going to do? Are you going to learn how to be a plumber? And we didn't even touch on the fact that, like, if you buy a licensed industry, well, now you need to go get your license. So there's a lot that goes into buying a business, and we're just talking just on the operational side, not the financing, not the culture, none of that stuff. So there's a lot to go into, Sean.
Of all those things that you mentioned, what would you consider the biggest misconception someone has when they buy a service business?
Oh yeah, maybe the biggest. I'll split it into 2. So the biggest misconception brand new people have when they look at the idea of buying a business, say you're just now getting into it, you're searching around, is looking at EBITDA or SDE and thinking, oh, that's how much I'm going to get. Like, you know as well as I do, these are leveraged buyouts. 45% of that cash flow is gone on day one. That goes to the bank. And so if you're looking at a business and you're like, hey, my buy box is $500,000 of SDE all the way to $1 million in SDE. Well, if you buy $500,000 of SDE, you really only have $250,000 of SDE. And now you got to take out your paycheck, whatever you're paying yourself. That means after that, you probably got $115,000 to $150,000 of actual growth capital in the business. Good luck. These are, that's really tough to grow on. It's very, very thin margins. That's one of the first most important things that first time buyers don't understand when they're first getting into the space, is that money is not your money. That is the business's money. And you are most likely going to have to take a serious haircut on your salary when you buy a company like this. And one way to get around that and to actually have a better outcome is to buy bigger. And you should absolutely try to find a bigger company to buy. One, to help maintain a salary that keeps you comfortable to where you can reinvest in the business without being worried about your how much money you're going to have for food next week. But also because the bigger the business, the lower the risk. And we can dive into that as well. But that's the biggest misconception that like brand new people in the space don't get. The biggest misconception business buyers have when they first buy the business is that they're so focused on finances. Now, you absolutely do need to understand your finances. Like that's par for the course. Like not only do you need to understand your financial model, but you also need to have a 13-week rolling cash flow. You need to know what to expect with your finances. And that's not the whole game, but that's the keys to play. That's you getting in the room, right? So if you don't have that, you're not here. But assuming you have that, that's not the most important thing. The most important thing is the culture of the business. And this is the piece that I seriously misunderstood when I first bought my business. I was looking at the finances, I was looking at the synergies, I was looking at the customers and the vendors and all that stuff. I was like, wow, this is gonna be really great. And I didn't really think about the culture of the business. I didn't think about the fact that am I gonna get along with the employees? Am I gonna get along with the supervisors? Am I gonna the business I bought, the owner that owned that business, they built that business to reflect their personality directly. They hired people that they liked. They put in systems that they liked, or they didn't put in any systems because that's who they are. And so you have to understand the culture of the business itself. And is it a good fit for you? Because the truth is that a business is the direct reflection of its owner. And one day, if you buy a business, that will be you. But just like digital transformation, culture transformation does not happen overnight either. It's going to take years. Unless you purge everybody on day one and start fresh, it is not your culture. So you're taking over somebody else's workspace, their culture, how they've managed their people, what their people are expecting, how they like to do their jobs, the way they interact with each other, the way they interact with customers. All of that is stuff that you're inheriting. You're not just inheriting the cash flow. And that's the piece that people really miss because, the biggest difference between a business and real estate or anything else is that a business is exponentially more valuable than its assets. If I buy real estate and it all goes to shit, well, then at least there's a physical asset behind it that, there's some sort of collateral. That's why, that's why lenders like to collateralize on assets, especially when it comes to real estate. You can get a loan for anything when it comes to real estate because there's something there backing it. But with a business, even at the most capital intensive businesses, think landscaping companies or companies that have lots of equipment and trucks, all of that combined is going to be less than 5% of the actual book value of the company. It's not even close. You can liquidate all your equipment. It's not going to matter because the value of the business is the value that's created when you bring people together to create something, and the equipment is just a piece of that. And so the whole thing is culture. And if you're not able to grasp that and work in that and grow that, then the whole thing falls apart.
Two things. One, you mentioned 13-week cash flow cycle. For our listeners, what is that exactly? And then piggybacking on that, what is the information that these YouTube celebrities, what are they missing in general?
Yeah. So real fast, a 13-week forward cash flow is just it's a running cash flow analysis where you have documented all of your income streams, all of your expenses, all of your vendors, and you have modeled out at least 13 weeks ahead of time of what cash is coming in and coming out of your business. That way, 3 months from now, you should have a pretty good idea of how much money is going to be in your bank. That's the whole idea. So you can capture all of that. That way, when something happens today or next week, or you find out there's this random, like, imagine like, one of your employees is driving a company truck and wrecks it on the freeway because they were drinking and driving. And now there's this workman's comp claim and there's all this other stuff. You get insurance hits. Like, you need to know, like, when those types of unexpected expenses happen, how's that going to impact cash flow, 2, 4, 6, 8 weeks from now? That's critically important, because it doesn't matter how much revenue you have. It matters how much cash you have. If you don't have enough cash, you're going out of business. You can have $5 million in revenue, but if you run out of cash, you're bankrupt. So that's why the cash flow projection is so important, especially for a brand new owner, because you need to understand where every single one of your dollars is going. And this is something that, a lot of MBAs who buy companies, this is something that they don't understand so much, because they'll show up, especially the PE guys, but really it's everybody. I mean, it was me too. I mean, you show up with your Excel spreadsheet and your leverage buyout calculator, and you modeled it all out, and you're like, I know where all the money's going. And you look at the owner of this company, who's been an owner for 20, 30, 40 years, and their processes are terrible. Like, they don't know how to build this model. They barely have an accounting system, if at all, and they're running it all off like one business checking account. And you look at it, and it's easy to think, wow, so unsophisticated. I'm gonna totally rock this thing. But what you miss is that even if they don't have all the fancy tools, and maybe they don't how to model, they don't know how to model out their cash, they know where every single one of their dollars are. Every single dollar at all times. They know where it's at. They know where it's going. They know where the next one's coming from. They always know where their dollars are. And if they didn't, they'd be out of business a while ago. And that's the key skill that you have to learn. And so that's why the cash flow analysis is so important. That's the first pice. What was the second part of the question?
Celebrity YouTubers.
Oh,
what are they missing?
So I'm not going to call anybody out on name, that's for sure. But what I found is that, look, like I said, when I first got into this, there were no celebrity YouTubers or anybody, social media people, spouting buying a business. The only person was Walker Dybel, and he wasn't celebrity-ish. He was celebrity if you read the book, but he wasn't on social media. Nobody knew that. And so there wasn't any of this. But after my experience of searching, buying a company, buying the second company, experiencing the ups and downs, and ultimately experiencing business failure, that happened in early 2024. And I kind of fell into that sucks. I kind of pulled myself into a cave for a little while, trying to figure out, what I'm going to do with my life. My personal finances were shot. My family and I, we had to move in with my brother, because we had nowhere to go. We lost our house. We lost all of it. It was just total financial wipeout. And so it gave me some time to really think about, be really critical about, hey, what were the things I did right? What were the things I did wrong? What were the things that were outside my control? And be really serious about that. And then around August of 2024, I started coming back into the world a little bit. And I opened up LinkedIn. I kind of, started messing around. And that's when I really saw it. That's when I really saw like all the social media gurus out there. And it really upset me in a lot of ways, because the thing that people are really missing is that the reason the social media gurus do so well is because there's a hint of truth to almost everything they say. That's the scary part. There's a hint of truth. Is it possible to buy a business with 100% seller financing? Yeah. Does it happen? Sure. Should you do it? No. You should not. In 99% of cases, you should not, especially as a first-time buyer. You should not buy with 100% seller financing. You shouldn't, for a lot of reasons. I'm happy to go into them. If you think that buying multiple small businesses is a idea of building a portfolio of small businesses, then you don't understand risk. Just plain and simple. You think you're smart because you understand, like you look at it and you're like, oh, it's kind of like stocks. I can put together a portfolio of these things. I can hire someone else to run it for me. And you think it's kind of like a portfolio of other things, but you don't understand risk. And you don't understand that if one of these businesses fails, it's going to take down the rest with you. And I'm not even talking about the fact that you probably signed a personal guarantee on each one of those companies. And so you don't understand risk. And I also know you don't understand risk because if you have some sort of portfolio, those are most likely small businesses, 2, 4, 100,000, maybe even $1 million of revenue. It is a tiny, tiny business. It is the riskiest asset you could possibly be in. And anyone telling you that you should be buying, 5 different types of small business, you should buy a car wash and a laundromat and like put them all together and it's going to be great because they all offset each other. And it's, whatever BS they're saying today about how it's, recession resilient. No, it's a lie. It is incredible amounts of risk, absolutely incredible amounts of risk. And I can just keep going on this. If you think that you're going to do a roll up, then you are delusional. Roll-ups require a lot of capital. if you think that you're going to buy a company and you've never bought a company before, but you're going to use the SBA and you're going to buy a company and then you use that to buy another company, another company, another company. That's not a roll up. That's a strategic acquisition. And you're only using the cash flow of the business that you buy to buy the next business. That's totally fine. That's a great long-term strategy. I would implore you to buy company number one, figure that out first. That'll let you know whether or not the rest of it even makes sense, because it probably doesn't, but I hope it does. If you want to see someone who's doing it really well, Nathan Lindley at Lindley Home Services in Texas is doing that. He bought an HVAC company in the DFW area, and then he definitely took some lumps early on, but now he's turned that thing around and he is buying up mom and pop shops all over the state, and he's doing a great job of it. So if you want to see what that looks like. A roll-up is you raising a lot of money through a fund and buying lots of small businesses with a platform and putting them together. And the reason I bring that up is because when you do that, we talk about not just the integrations, but the finances. We're disregarding the culture because we're going to fire a lot of people. Like, there's a lot of things that go into a roll-up that you simply don't understand, especially if you've never bought a business before. You've never operated a business before. And you may be thinking, hey, I want to do the holdco model. That's great. Holdcos are wonderful. All of these things are wonderful. Buy the first business first. Operate that business. Learn what it means to own it. Learn what it means to stay awake at night wondering if you're going to hit payroll or not. Understand your own risk profile. And if that works for you, then great, then move on. But like I said in the beginning, you have to be comfortable with the fact that your base case is that first business you buy is probably going to be where you stay, right? Things are probably not going to go super well. I mean, I hope that they do, but you have to understand that if you buy a business with a leveraged buyout, especially with SBA, and you're levering up 90% to buy this company, you're not going to have any cash flow for the next 8 to 10 years. It's going to take time. And you may be thinking, oh, well, I'm just going to grow the business. That's how I'll get cash flow. Great. I hope that works for you. Have you ever done that before? I mean, I want you to figure this out first, And Sean, you know this as well as anybody, but in private equity, when we do leveraged buyouts, and I say we, I don't do them, but when you do a leveraged buyout, 40 to 60% debt is standard. 60% is considered high. That's considered a risky buyout. But with the SBA, we're like 90%, 95%, no problem. First time buyer, no problem. It's lunacy. It's total stupidity. So coming back full circle, the problem is that there's a hint of truth in every single thing these influencers say. But because you've never run a company, you just don't understand and you'll fall for it. And you won't understand the nuance to the argument. And it's the last thing I'll say on that is, look, I served in the Air Force for 10 years. When I left, I was a master sergeant. I had deployed a couple times. I led troops. And I get that same question when I was in that every service member gets, from someone who's never been in. They're like, hey, what's it like? And man, I can tell you what it's like to go to basic, and I can tell you what it's like to put the uniform on. I can tell you what it's like to deploy. I can tell you what the sunset looked like in Afghanistan. But the truth is, you have no idea what I'm talking about. You have no clue, because it's more than just the stuff you did. It's the culture you're surrounded in. It's the environment you're in. And I can't replicate that for you. You have no idea what I'm talking about. And it's the same thing with operating a business. If you've never done it before, you don't understand. And if you think it's something that you want to do, then that's great. You should go do that. You should give it a shot. You'll never know if you don't do it. And maybe it is for you. But I implore you to learn everything you can about it, understand the real risk involved, and then de-risk that first acquisition as much as possible. Because the only goal with the first acquisition is simply not to fail. That's it. Just don't fail on the first one, because you're going to learn everything you need to learn just on that first business acquisition. And then at that point, you'll know, hey, is a roll-up for me? Is a holdco for me? Do I want to expand? Is this business even for me? I don't know. Just de-risk that first one as much as possible. And as you can see, I've got quite the soapbox on this because I know what it feels like to lose it all.
Question there as well. I mean, another thing that I think is pretty interesting that seems to have grown in popularity over the last year or two, or at least in my inbox, search funders. These people that have graduated MBA programs. I'm just going to go in a little bit more detail for our audience. And we actually interviewed John Steckman. Look at our archives. He has a fund that funds search funders. It was about 30 episodes ago, I'd say. But, these people, they look for companies for a year or two. That when they're in a process, just wondering from your point of view, how are they at such a disadvantage to private equity and institutional buyers?
Yeah, well, I mean, it's plus and minus. They're at a disadvantage when it comes to capital. Absolutely. They're at a disadvantage when it comes to lead generation and sourcing. Absolutely. they're at a disadvantage when it comes to experience and operations and systems. So there's a lot of disadvantages there. And happy to dive into each one of those. But they are an advantage to building a relationship with the seller. That's one area where they're a huge advantage. And I do see search funders do well, when it comes to building a relationship with the seller and being able to outcompete PE groups and strategics when it comes to making a deal. But only because the owner already has a predisposition not to sell to PE, and because they have an idea of how they want their business to be operated after them. That's where a search funder can really step in and make a difference. But outside of that, it's a real uphill battle. It really is. And you don't need to take my word for it. You can look at the Stanford study. They release it every single year out of Stanford University. And if their numbers are, none of this is scientific because no one really knows. It's all proprietary markets. So all of their data is self-reported, and it's almost all from them. So, there's a few other places, but it's almost all from their graduates. And so you have to take it all with a big grain of salt. But even going by their numbers, half of their people who raise a search fund never actually acquire a business. So that's, 50% are out automatically. And then of the 50% who actually do acquire a business, a third of them have a negative outcome. A third of them never reach the returns they were looking at. And then the high third get that, 30% IRR, they were always hoping for. And so it is absolutely not the silver bullet that everyone thinks it is. So there's a lot of things to think about there when it comes to raising a search fund or doing a self-funded search. But, I do think that if you're able to raise a search fund, it does offer you some opportunities. It does give you an advantage if you're looking to build a relationship with owners, but you have to be very strategic. It takes a long time. There's a reason why it takes 2 years, because you're having to compete directly with all the lower middle market PE groups, which is really, really tough. And you don't have to be the biggest money in town, but you have to at least be in the ballpark. If you find an owner who likes you and they know they're going to sell for like 7 million, and PE shows up with $7.5 or $8 million offer, and you show up with 6.5, then at least you're in the ballpark. An owner will take a couple $100,000 as a haircut if they like you and they think you're a good fit for the business. But if you're not in the ballpark, they're not going to pay attention. So the last thing I'll say on that is, we also need to be realistic about search funds. Search funds are really only realistic for MBA grads from very elite universities. And I mean, not just the M7. I mean, if you didn't go to Stanford, Chicago, Kellogg, Harvard, Penn, that's about it. Maybe Columbia. And I say that because search funders are funded ahead of time by investors, most of whom are their own alumni. And this is kind of where it all began. And so if I've seen MBA grads come out of Duke, I've seen MBA grads come out of North Carolina, come out of Stern, come out of a lot of really great programs, Michigan, and not get funded for a search fund. And so you have to understand, it's probably not going to happen for you. Just let's be clear about that. Unless you're out there making relationships with investors to the point to where they're ready to fund you, you have to understand that it's probably not going to happen. So raising a search fund is unlikely. Self-funded search is probably the most likely, way that you're actually going to be able to move forward and actually buy a business.
Okay, so instead of, say, the company's doing great, maybe it's going in the opposite direction and heading towards insolvency. What should owners or potential buyers be aware of in that situation?
Yeah. So first and foremost, if you're a first-time buyer, you should not be buying a distressed company, period. If the revenues are down, if EBITDA is dropping, even more so if it's in an industry that's in decline, you should not be looking at that company. Warren Buffett has a great quote on that. He says, "I'd rather buy a great business at a good price than a good business at a great price." Right. And the whole point is turning around a distressed business is incredibly difficult. There are, distressed turnarounds as a whole industry, right? It takes a lot of expertise. It takes operational chops. It takes, you're essentially signing up to be an elite cardiac surgeon, on a business that's on the deathbed. And you got to be trusted, not just to, turn around marketing, but you have to be willing to cut off a limb in order to save this thing, do open heart surgery to save this thing. And first time buyers, well, one, you've never even ran a business. So you've never stepped foot in the hospital, much less in the operating room. So you're not ready. And then two, you're just gonna be terrified just to begin with. And two, it puts so much stress on you because as the buyer, you own the debt. You signed a personal guarantee. If this thing fails, you're insolvent. And then that just adds so much more stress on you. Turnaround experts, they don't own the company. That's one of the big things. They show up and they do the tough things because they know how to do them, and they don't have the stress of, oh, I'm bankrupt if this doesn't work. Like, they're able to think clearly. You're not thinking clearly. Like, when it's your life on the line, you're not thinking clearly. And so do not buy a distressed business for your first business. You need to find a really great business, something that's actually doing very well. No business is perfect, but you want to remove as many red flags as possible. And then if that means paying up a little bit, then do that. Then do that. Like, saying, I found this business, it's on decline, but I can get it for 2 times EBITDA. Run. That's not a deal. That's destruction. If you've already operated a couple businesses and not only have the experience, but have the experience in the industry, and you know exactly how to turn around the business, well, then it could be great for you. Then it could be a great opportunity. You can get incredible alpha doing that. But if you've never done it, then you shouldn't do it. Your first job on your first acquisition is simply not to fail. And signing up for a sinking ship is the easiest way to fail. So avoid it completely.
Are there any books or influencers out there that you think, if people really actually want to learn that's producing great content out there, other than the Silicon Valley podcast, of course, leave that one aside. Is there, at least I thought I was getting a smile there. Is there any other content creator out there?
There's a lot. Just double tapping on that, the distress turnaround. I recommend every single business owner buy Corporate Turnaround Artistry by Jeff Sands. Jeff Sands is one of the premier distress turnaround artists in the country. And he wrote this book back in 2020. And it's fantastic. Even if you have no intention of ever being a turnaround expert, it's really important for business owners to read that book, because it helps you cut through the noise and focus on what actually matters. Cash flow, incentives, where the debt goes, what does your capital stack look like, how to work with your vendors, how to work with your customers. Like, when things are really on the ropes, what do you do? And it just gives you so many tools. Unfortunately, I found that book after my business failed, but when I read it, it was like therapy. It really felt like Jeff was sitting next to me the entire time my business was failing, and just yeah, you should do that. It was like he knew. It was really weird. But so I recommend that book to every single business buyer out there. If you're going to buy a business, buy that book, read it through. Now, as far as influencers, there's a lot of great people in the space who are doing great work. David Barnett is doing great work. He's a business owner. He's a sell side advisor. He's a buy side advisor. I bought his course. He was one of the few people out there. I bought his old business buyer course when I was first searching. The thing I like about David is that he comes at it from a risk on perspective. He comes at it from a very you need to think about all the ways this is going to fail. And that's the only way to be successful. So I really appreciate that. I think, reading the HBR guide to buying a small business is definitely kind of the Bible in the space. Do that. Walker Deibel's Buy Then Build is great. But then as far as when it comes to it's less about influence in the space. It's more about building out your network. So one of the really good things about buying a business becoming so mainstream over the last couple of years is that there is now a professional services network built up around it. When I was first starting out, when I was first searching, there were no dedicated small business lawyers or accountants or quality of earnings, individuals. There was none of that. You had to find people who actually specialize in that, and kind of the middle market, if you were going to find it, and tell them what you were doing and see if they could help you. Now there are dedicated firms. So the guys over at SMB Law Group do a fantastic job of helping first-time buyers understand the legal ramifications of an acquisition. There's a lot of really good brokers out there who do a really good job of educating not just buyers, but also sellers. And you can find them on LinkedIn. Jason Roberson's a great one. Clint Fiore in Texas is fantastic. And there's a lot of guys and gals out there doing incredible work doing that. There's tons of CPAs out there. Quality of earnings professionals. Caleb Basile is a great Q of E guy. You can find him on LinkedIn as well. There really is a great network now. And the thing with the network is that if you're wondering if somebody's an influencer and trying to get you to buy a course just because you're the product, or if they actually want to help you, the difference is what they're saying and who they're networking with, right? Because if you're an influencer and your only goal is to sell a course and get someone to buy, then you're not showing up at SM Bash. You're not showing up at ETA conferences. You're not showing up on podcasts with lawyers and CPAs and quality of earnings professionals. That's the difference. See who people are actually spending their time with, because people will say all manner of BS. They're oh, I bought this company, raised it 35 million, and blah, blah. Here's my guy, blah. Sure. Like maybe you did, maybe you didn't. I don't know. Like I haven't seen your financials. I didn't sign an NDA. I don't know if that's true or not. Like you have to understand that everyone is kind of full of crap. Like you can say whatever you want, but unless they turn over their tax returns, it is what it is. And so your reputation is built by your network. So like I'm talking with you right now, Sean. Like that tells you that like I'm at least open to talking about my experiences. You're talking about yours. And so, we're having a dialogue here. And I'm going to talk to lawyers. I'm going to talk to CPAs. We're all going to talk together and we're going to call each other out on things that don't make sense. Right. So one of the biggest tells of an influencer who's peddling BS is that they're not going to spend time on, showing up at an ETA conference because they know they're full of crap. So that's one really great way to do it. I think one of the last thing I'll say is one really great way to get involved in the space and start building out your network is to show up at ETA conferences. You can find entrepreneurship through acquisition conferences at every major business school all across the country. You don't need to be a student to go. Just buy a ticket, go. It's great. You'll meet a lot of other searchers. You'll learn a lot from people who are there. And then importantly, that's where the investors hang out. You got to meet them too. Like you got to meet people. And so you're only as strong as your network. So that's where all the professional service providers will be as well. So, get to know people, meet people. And then that's how you'll be able to start cutting through the noise of like who's full of it and who actually has something to offer.
And Jed, you have a book coming out. Can you share a little bit about that book? And can you maybe share a story or two that made the book or maybe didn't even make the book?
Yeah, absolutely. So I've got a book coming out this fall called Buyer Beware. It is a compilation of real stories of business buyers who acquired a business within the last 5 years and then that business failed. And it's a genesis of the fact that like when my business failed, I thought I was one of the exceptions to the rule, right? Just like you, I was looking at the SBA default, right? And I was like, damn, I was the unlucky guy, right? Turns out I'm not the unlucky guy. Turns out there are hundreds of people out there just like me. And there's two big reasons why you don't hear about them. One, because it really, really sucks to go on LinkedIn and say, hey guys, I'd love to announce that my business failed and now I'm broke. Now I'm living with my brother. That's a shitty thing to say online. Everyone's flexing. No one wants to say that. So that sucks. And I have done that. The second thing, though, is that when these businesses fail, 90% of the time, there's a non-disclosure agreement and a non-disparagement agreement signed, which means you can't talk about it. That's why even when I'm talking with you here, Sean, I'll talk about some of the things I experienced, with my businesses, about the things that went right, the things that went wrong. But there's some details I can't talk about because I have a settlement in place with an NDA and a non-disclosure agreement and a non-disparagement agreement. And so there are some things I don't talk about. And that was so frustrating because I want to talk about all the things that were so messed up. And a lot of people who have been through this, just like me, they want to tell you and they can't tell you, right? Because they don't want to open themselves up to legal action. And so I had this thought, and I remember I was always a big fan of Tim Ferriss, right? Read all his books. But he had a couple books. One was Tools of the Titans and like those compilation books, right? And so I had this thought. I was like, look, there's all these stories. What if I put together a compilation book? What if I put together a book of like 24 to 30 of these stories, and I anonymized all the stories so that no one will get in trouble for them. And that way I could just get the lessons out there, like a bunch of case studies. And that's exactly what this book is. And I'm really excited about it because, there's a lot of really interesting things in there that are going to help first-time buyers really avoid major pitfalls that some of us have fallen into. And like you asked, so here's a couple. So I expected that the number one reason small businesses failed would be because of cash conversion cycle and cash flow. That's the number one reason most businesses fail. But what I found through my non-scientific study of just the people I've spoken with over 35 at this point, is that in 65% of these cases, it's seller fraud. It's either direct seller fraud or seller misalignment. And what I mean by that is either the seller didn't disclose something that they should have, or they outright lied to you, or the business was outright fraud, or there was some things in place that you had in your agreement that they simply didn't fulfill on. Right. So here's a couple examples. I met somebody who acquired a business that was a roadside business, and this business, trying to find the right way to say this without giving it all away. But basically, it was a moving company, right? And so they would, whenever time you're moving from one place to another, you'd show up, they'd move all your stuff for you, and they'd move somewhere else, right? And what the problem was is that they were contracted to move all your stuff from A to B, and then you paid a flat fee for that. But the issue is that every time they would do these moves, they would skim a little bit off the top, and they wouldn't recognize it as revenue. And so it's not a big deal. You'd think it's kind of under the table, whatever. They also weren't paying, they were paying their employees under the table. These were things that the buyer didn't catch because the buyer didn't do a Q of E. These are easy things to catch on a Q of E. Like, the payroll doesn't match up, the costs are off or whatever. And because that didn't work, when the buyer actually bought the company, they had, I think 90% leverage on this company, and they couldn't support payments because they didn't have the cash flow to cover it. So that's one of those things where it's like, it's not fraud. It's the seller just not giving you all the answers, not telling you everything that's happening in the business, you not asking all the right questions, and then you not doing your due diligence by doing a Q of E, and that puts you in a bad spot and the business fails. Another example is there was somebody who bought a company, and it was
just to stop you right there, just for our audience. Q of E, quality of earnings. If people
quality of earnings
want to check that out, we did have a prior episode with Elliot.
Elliot's a great guy. I should have mentioned him as well. He's fantastic.
He was on our show. So yeah, I definitely recommend checking that archived episode. And also there's another one with Brett Brunel on financials that's in our archive. So for our audience out there, please check those out. Jed, please continue.
On a side note, do not buy a business without a quality of earnings. Just simply don't do it. If you don't do that, you simply do not understand risk. I'm just going to leave it at that. I mean, there is no higher ROI than getting a Q of E in your due diligence. So you're welcome, all the Q of E professionals. So anyway, okay, how about another one? I met somebody who bought a company, and everything looked really great. They bought the company, they stepped in, and then after they bought the company, they found out that there was a backstory here. And so the owner of this company was doing all their payroll through a local payroll company, right? And they'd been doing it like that for like 30 years. And about around the 2008 financial crisis, the company had fallen on hard times, and they didn't have enough money to cover payroll. And so the payroll company, who was run by his friend that was local, was like, "Don't worry about it. We'll float payroll for you." No agreement, no contract, just a handshake, because they'd known each other for years. And they covered the payroll. And it's like, just pay me back when you get a chance, throw 2% on it. It's like, cool, no problem. And so they've been doing that. And they kind of been doing that ever since. And so there was this outstanding balance with the payroll company that wasn't showing up on the books. There was no contract to show you that it was there. There's nothing in the background at all. And so the buyer bought the company, took over, and then a week after they buy the company, the old payroll, they're switching payroll companies, right? Because they did an asset purchase, they bought all the stuff, they were putting in ADP. They're like, yeah, we're not going to go with the old payroll company. And the owner of the old payroll company is like, yeah, that's cool and all, but you owe me like 150 grand. And he's like, what? And he's like, oh yeah, so the seller told me that you were going to cover that. He's like, I'm not going to cover that because I did an asset purchase. That's not my bill, and I don't know what the hell you're talking about. And he's like, cool, well, if you don't do that, then I'm just going to cancel all the checks for your employees. By the way, those checks are supposed to be out tomorrow. And if you know anything about services business, if employees don't get paid, they don't come back to work. And so the owner had to make a very, very quick decision and say, all right, well, I'll pay, but we're getting all those checks out today. And then immediately was like, we have to move on. And then found out that the owner had also gone around to all their vendors and left outstanding balances at all the vendors saying, hey, don't worry, the new guy's going to buy it. And again, you may think, well, yeah, you did an asset purchase, so these aren't your bills. And that's true. They're not your bills. The vendors don't see it that way. The employees don't see it that way. Nobody gives a crap. And so if you show up and everybody's getting all their supplies from one supplier or maybe two suppliers, and the owners of those suppliers are all told that you were going to pay that bill, and then you show up and say, oh, I'm not paying that bill, that's not my bill, go argue with the other guy. Well, that's legally fine, but you have already burned all your bridges on day one. So that sucks. And as you can imagine, that went into litigation for a very long time. And ultimately, the whole thing failed. And so there are lots of stories like that. The number one thing you have to do as a business buyer, the number one thing that's more important than the finances of the business, more important than anything else, is due diligence on the seller. Because the business is a direct reflection of the owner. You have to get to know the seller. You have to understand, is this the kind of person that pays their vendors on time? Do their employees like them? Do their customers like them? Do they have a good reputation around town? Like, all of these industries are very small and insular. Everybody knows each other. The employees know the employees at other companies. Like, the owners know each other. The owners went to high school together. Like, everybody knows each other. They all get their supplies from the same place. And so the reputation gets around. You have to do the due diligence of finding out, is this somebody I can trust? Is this somebody who's above board? Is this somebody who actually operates with integrity? Do a background check. Like, figure that out. A lot of it is simply EQ. Do things feel off? When you talk to them, are they lying to you? And there's a fine line here, because It is the largest, when you're buying a business, it is the largest transaction of the seller's life. It is 100 times bigger than ever buying or selling a house, which is the biggest transaction most people ever have. They only have one shot at this. And not only that, this business has taken care of them and their families for decades. Like, it put their kids through college, it took care of them, it paid for their house, paid for their vacations, paid for everything. And so if you think there's an emotional attachment to a house, it is 100 times more to a business. And so when you go into these situations, you have to expect that the owner is going to be stressed out, is going to be, frazzled. Their systems may be a mess. Their finances may not be great. There could be a lot of things going on. And that's okay. Like, that's expected. You should understand that going into it. But what is not okay, if the owner ever lies to you about anything, you need to run away from that deal as fast as you possibly can, because you're taking in a massive amount of risk as the buyer. So if you know that the owner will lie to you about something, then they're going to lie to you about something else. So do not deal with that. Also, if the owner knowingly misrepresents anything, so maybe they didn't lie to you, but maybe they didn't tell you that there was an outstanding account somewhere, or maybe they didn't tell you that their customer list was actually 30% smaller than what was portrayed in the sim. And that was something that not only that you found, but something that's obvious that they should know. Leave, because obviously they're hiding something from you. And so the seller is the biggest point of friction. That's what you have to watch out for. I'm convinced that there are more good sellers than bad sellers. There are really good people out there with lots of integrity who are looking for a liquidity event, because most of them will never find it. And they really care about their business. They really care about their employees. When they sell their company, they're not moving to Tahiti. They're staying there. They're in the community. They have been for decades. Their reputation matters to them. And that's why it matters so much who they sell the company to. And that's where a self-funded searcher or a search funder can really find an in. So that's your play. But finding somebody who lacks integrity, run. Because the last thing I'll say here is that one of the big misconceptions is you think that the law will protect you, and it will not. Like, you need to make sure that you have a really good legal team on your side and really airtight agreements. Your purchase agreement needs to be clear. Your representations and warranties need to be clear. Your non-compete needs to be clear. All this stuff needs to be in there. And that's absolutely important. But it will not save you from a bad seller. It will not save you from a bad outcome. What it does is it gives you a foundation to stand on when you go to sue, when you move into litigation. That's all it does. But let me be clear. If you move into litigation, you're screwed. Even if you win, you're screwed, because litigation takes a very long time. Think months to years. It is very expensive. It's going to cost you a lot of money. And if you're moving into litigation, then that means something happened that has already handicapped that business in a serious way, which means you're still dealing with that until there's an outcome. And so you're already screwed. And let's assume you get to the point to where you get to a settlement. Well, these are civil litigation. So 80% of civil litigations never actually pay out. So there's no guarantee you're actually going to get anything. You're probably not going to get anything at all. You're going to spend a whole bunch of money to get to a settlement to where there's nothing left. And so the law will not save you. It really is the Wild West of capitalism. So it is agreements between people that trust each other. So take the time to get to know the people that you're actually doing deals with. This goes equally true for partners. It goes for everybody else. Learn that lesson really quick.
Jed, if anyone wants to find out more information about you, your book, what you're working on, what's the best way to go about doing it?
LinkedIn, man. I'm on LinkedIn. I recently started kicking up my YouTube channel. There's 147 subscribers, so I'm real big. I'm starting to get on that, but you can definitely find me on LinkedIn. I post there pretty regularly. And if you DM me, I do my best to reply within 24 hours. So that's the best place to reach out.
All right. And for our listeners, just a reminder, this content is for general educational purposes only and is not intended to be or should not be construed as legal, tax, accounting, securities, or investment advice. It does not constitute a recommendation or solicitation of any kind. And with that, Jed, I want to thank you for taking the time to be on this week's episode of the Silicon Valley Podcast.
Sean, thanks for having me. This is fun.